Welcome to Anheuser-Busch InBev's first quarter 2023 earnings conference call and webcast. Hosting the call today from AB InBev are Mr. Michel Doukeris, Chief Executive Officer, and Mr. Fernando Tennenbaum, Chief Financial Officer. To access the slides accompanying today's call, please visit AB InBev's website at www.ab-inbev.com and click on the Investors tab and the Reports and Results Center page. Today's webcast will be available for on-demand playback later today. At this time, all participants have been placed in a listen-only mode, and the floor will be open for your questions following the presentation. If you would like to ask a question at that time, please press star 1 on your touch-tone phone. If at any point your question has been answered, you may remove yourself from the queue by pressing star 2. If you should require operator assistance, please press star 0. Some of the information provided during the conference call may contain statements of future expectations and other forward-looking statements. These expectations are based on management's current views and assumptions and involve known and unknown risks and uncertainties. It is possible that AB InBev's actual results and financial condition may differ, possibly materially, from the anticipated results and financial condition indicated in these forward-looking statements. For a discussion of some of the risks and important factors that could affect AB InBev's future results, see risk factors in the company's latest annual report on Form 20-F filed with the Securities and Exchange Commission on the 17th of March 2023. AB InBev assumes no obligation to update or revise any forward-looking information provided during the conference call and shall not be liable for any action taken in reliance upon such information. It is now my pleasure to turn the floor over to Mr. Michel Doukeris. Sir, you may begin.
Thank you, Jesse, and welcome everyone to our first quarter 2023 earnings call. It is a great pleasure to be speaking with you all today. Today, Fernando and I will take you through our first quarter operating highlights and provide you with an update on the progress we've made in executing our strategic priorities. After that, we'll be happy to answer your questions. Let's start with our operating performance. Our business momentum continued this quarter, and we are very pleased with our strong performance to start the year. We delivered revenue growth of 13.2%, with volumes up by 0.9%. Revenue per hectoliter increased by 12.4%, driven by price actions across our markets, other revenue management initiatives, and ongoing premiumization. We grew EBITDA by 13.6%, with a margin expansion of 13 basis points, despite continued commodity cost headwinds and while increasing sales and marketing investments in our brands. Underlying EPS was $0.65, a 8.7 increase versus last year. Our focus on disciplined resource allocation and everyday efficiency continues to enable us to invest for the long term while delivering consistent, profitable growth. We delivered broad-based growth this quarter with both top and bottom line increases in all 5 of our regions. Revenue increased in 80% of our markets, with volume growth in over 60%. Our diverse geographic footprint provides a unique combination of growth and reliable cash flow generation, positioning us well to deliver superior long-term value creation. Now, I'll take a few minutes to walk you through the operational highlights for the quarter from our key regions, starting with North America. In the U.S., the beer industry remains resilient, with industry volume trends improving sequentially and U.S. dollar sales up 3%. Our business delivered another quarter of top-line growth and stable EBITDA, despite the elevated cost environment. Our above-core beer portfolio continued to gain share of segment, growing volumes by mid-single digits. Since we are talking about the U.S., let me share some thoughts on the Bud Light situation and put it in the context of our global company. Let me start by clarifying a few facts. This was the result of one can. It was not made for production or sale to general public. It was one post, not a formal campaign or advertisement. Bud Light campaign is easy to drink, easy to enjoy. We should address the situation through the lens of three areas that are very important: our people, our consumers, and beer. Let's start with our people. This situation has impacted our people and especially our frontline workers, the delivery drivers, sales representatives, our wholesalers, bar owners, and servers. These people are the fabric of our business. They are our neighbors, family members, and friends. They are in every community in America. We've been doing everything we can to support our teams and ensure their safety while continuing to brew, package, and together with our wholesalers, deliver great beer to the market. We are providing direct financial support to the frontline teams that work for us and our wholesalers. As to Bud Light, we have significantly increased our investments behind the brand in the U.S., including tripling our media spend over the summer. Now, let's talk about our consumers. We continue to be committed to the programs and partnerships that we have forged over decades with our consumers and with organizations that represent a wide range of communities where we operate. We work every day to delight our consumers and bring people together. When we do this well, our brands perform. Finally, let's talk beer. Everything we do should be about beer and should promote beer. Beer is an essential part of life's meaningful moments, whether in sports, music, or celebrations. These are moments that bring people together, and this is why I love beer. While beer will always be at the table when important topics are debated, the beer itself should not be the focus of the debate. Bud Light is about being easy to drink and easy to enjoy. That's what consumers want, and that's what we are focused on delivering. We stand behind Bud Light, and will continue to invest in the brand to drive it forward. As CEO, I'm accountable for our results, this company, and our shareholders and stakeholders, and my team. Bud Light is very important to our U.S. business, and I would never minimize the situation. However, seeing the context of our global company provides perspective. Over the years, our global footprint has enabled us to successfully navigate different types of challenges, such as temporary ban on beer sales in certain countries and the months-long shutdown of bars and restaurants across the globe. With respect to the current situation and the impact of Bud Light sales, it is too early to have a full view. The Bud Light volume decline in the U.S. over the first 3 weeks of April, as publicly reported, would represent around 1% of our overall global volumes for that period. With this perspective, and in the context of our global business, we believe we have the experience, the resources, and the partners to manage this. And our full-year EBITDA growth outlook is unchanged. In summary, we are focused on our people, our consumers, and beer. We want to reiterate our support for our wholesaler partners and everyone who brings our great beers to the market. I can tell you that we have the agility, resources, and people to support the U.S. team and move forward. We will continue to learn, meet the moment, and come out stronger. And we work tireless to do what we do best, bring people together over a beer and creating a future of more cheers. Now, moving on to our largest region, Middle Americas, which continues to deliver strong results. In Mexico, we continue to outperform the industry and grew top line and bottom line by double digits. our volume growth was broad-based, led by our above core beer brands, which grew by low teens. Our digital direct-to-consumer platform, Tada, is now operating in over 50 cities and fulfilling, on average, over 300,000 orders per month, enabling us to build closer connections with our consumers. In Colombia, our business delivered top-line growth with our beer portfolio continuing to gain share of total alcohol, despite inflationary pressures impacting consumer demand. EBITDA declined low single digits, driven by anticipated cost pressures. Our leading mainstream portfolio drove our performance, delivering mid-single-digit revenue growth. In South America, our business in Brazil delivered double-digit top and bottom-line growth, with 235 basis points of margin expansion. Our beer volumes grew by 0.9%, with stable market share despite lapping a strong comparable. Our premium and super premium brands led our growth, delivering a volume increase in the mid-30s. Now, let's talk about EMEA. In Europe, we grew top line by double digits, with flat volumes despite a soft industry. EBITDA grew by high single digits. We continue to premiumize our portfolio, with our global brands and super premium portfolio delivering low teens revenue growth, led by Budweiser and Corona. In South Africa, we delivered record high volumes for the first quarter and grew revenue by high single digits. EBITDA declined by low single digits, impacted by anticipated commodity cost headwinds. Our performance was led by Carling Black Label, the #1 beer brand in the country. Our premium, super premium, and beyond beer portfolios all delivered double-digit increases in revenue. And finally, APAC. In China, our business delivered double-digit top and bottom-line growth as channel traffic continued to normalize and consumer demand for our portfolio accelerates. We delivered volume growth across all segments of our portfolio, led by our premium and super premium brands, which grew by approximately 10%. Now, I would like to share with you a few sustainability highlights. We continue to work in collaboration with our suppliers to drive decarbonization across our supply chain. In March this year, we were recognized by CDP as being a top supplier engagement leader in 2022. In circular packaging, our teams won awards for our innovations using upcycled barley straw and majority recycled marine waste for Corona six-packs and crates. Now, let's move on to our strategic pillars. Let's start with pillar 1 of our strategy, lead and grow the category. We continue to execute on our 5 levers to drive category expansion and delivered strong quarter of consistent and profitable top-line growth. We are leading and growing the category by offering superior core propositions, developing new consumption occasions, and expanding our premium and beyond beer portfolios. Our global brands continue to scale and drive premiumization across our markets. The combined revenues of Corona, Stella Artois, and Budweiser grew by 15.4% outside of the brand's home markets, led by Budweiser, which grew by 17.8%. Now, let's turn to our second strategic pillar, digitize and monetize our ecosystem. These continue to accelerate usage and reach, capturing $8.2 billion in gross merchandising value this quarter, a 32% increase year over year, and reaching 3.1 million monthly active users. Customer satisfaction continued to improve, with our weighted average Net Promoter Score improving to positive 59, up 11 points since last year. In 15 of the 20 markets where BEES is live, our customers are also able to purchase third-party products through BEES Marketplace. Customer adoption is increasing, with 59% of BEES customers now also BEES Marketplace buyers. In the first quarter, BEES Marketplace generated approximately $295 million in GMV, representing $1.2 billion on an annualized basis. Now, let's talk about how we are strengthening our direct relationship with our consumers. Our digital D2C products, Zé Delivery, Tada, and Perfect Draft, are now available in 20 markets and generated over 16 million orders and $100 million in revenues this quarter. With that, I would like to hand it over to Fernando to discuss the third pillar of our strategy, optimize our business. Fernando, over to you.
Thank you, Michel. Good morning, good afternoon, everyone. We aim to maximize value by focusing on three areas: optimize resource allocation, robust risk management, and efficient capital structure. With respect to capital allocation, we are focused on maximizing long-term value creation by dynamically balancing our priorities. We continue to invest in organic growth to support our strategy to lead and grow the category and digitize and monetize our ecosystem. The excess cash generated by our business is then dynamically allocated to our three capital allocation priorities: deleveraging, selective M&A, and return of capital to shareholders. Our debt maturity profile remains well distributed, with no bond maturities in 2023 and no relevant medium-term refinancing needs. If we look at our debt maturity profile, we have $3 billion worth of bonds maturing through 2025. Our bond portfolio has an average pre-tax coupon of around 4% and a weighted average maturity of 14.5 years. In addition, our debt portfolio does not have any financial covenants, and it is comprised of a variety of currencies, diversifying our FX risk. 95% of our bonds have a fixed rate, insulated from interest rate volatility and inflation. As a result of our deleveraging progress, strong free cash flow generation, and robust risk management practices, both Moody's and S&P recently upgraded our credit rating to A3 and A- respectively. And now, let me take you through the drivers of our underlying EPS this quarter. We grew underlying EPS by 8.7% versus last year, delivering 65 cents per share. This increase was primarily driven by nominal EBITDA growth, which accounted for a 13 cents per share increase. As we continue to deleverage, our net interest expense has reduced, contributing a 1 cent improvement. Higher income tax reduced EPS by 4 cents, driven by country mix. With that, I would like to hand it back to Michel for some final comments before we start our Q&A session. Michel?
Thanks, Fernando. Before opening for Q&A, I would like to take a moment to recap my key takeaways for the quarter. We continue to make progress in executing across each of our three strategic pillars. Our business momentum continued this quarter. Driven by the strength of our leading brand portfolio, we grew volumes in 60% of our markets. We made important strategic choices in pricing and other revenue management initiatives, which drove continued strong net revenue per hectoliter growth of 12.4%. We progressed our digital transformation, generating $8.2 billion in GMV through BEES, with 59% of BEES customers now also BEES Marketplace buyers. EBITDA grew organically by 13.6%, and our margins expanded, even in the context of continued elevated cost environment. And as a result of our deleveraging progress and strong free cash flow generation, our credit rating was upgraded one notch by both Moody's and S&P. We are investing to drive long-term value creation, and our results this quarter are another proof point of the effectiveness of our strategy.